is what I'm talking about, Straza. This is great.
Yeah, really good.
Showbiz, babe. Showbiz.
My name is Steve. Pardon the price action. It's so fun.
Hey guys, JC Peretz here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action PTPA with Steven Straza. Straza, let's get right into it. We had some CEO shakeups today in both Lyft and Oscar Health. You like either of these charts?
So, yes. So Lyft, the CEO is out. They're bringing in somebody new. Same thing with Oscar Health. Interestingly enough, they're bringing in Mark Bertolini, who was the old CEO of Aetna. So the stock is reacting positively on the news. Oscar Health, that is. The only thing I would say about this, not really a fan of either charts, but there's nothing like price to change sentiment, right? So this morning, all the headlines about Lyft were, this is great, you know, they're bringing in a new CEO, preparing themselves for a sale, and everybody was jacked up about it because the stock was up 10%. By this afternoon, after lunch, stock is in the red now today, and all the headlines I'm seeing are about how there's problems, you know, in the boardroom at Lyft. So you never really know. These events are really tough to trade. If we're talking about, you know, Lyft in particular, the chart is ugly. We're looking at the relative trend here between Lyft and Uber. I'd rather be editor Uber.
That Lyft Uber chart, I think, really tells the story nicely. When you look at Oscar, how would it make you feel, Straza, if you're the CEO and you got out and stock's up 75% because everyone was thrilled that you're getting the hell out? Is that what's going to happen to the Knicks when Dolan's gone? Is that what?
They're bringing in an industry veteran, so I guess Wall Street's excited about this one.
I think that's hilarious. This chart tells it all. Lyft Uber continuing to make new lows. Come on.
Yep. Right. So just like rates refuse to roll over, bonds have been unable to break out. What do you think of the recent action in the bond market?
I'm looking at it every day. You know, the bonds, when you zoom out, like look at the IEF. This is the 7 and 10 years. So you're looking at a benchmark yield here for the bonds and just pushing up against, you know, resistance. You know, it looks a lot like a lot of technology stocks, a lot of like growth stocks. A lot of these internet stocks look very similar. Some of the software names, they're very, very similar. The correlations between, you know, these high growth names and treasury bonds has been so strong. So that's how I'm looking at it. So I think if you're in the camp that growth is going to keep doing well, that these software stocks and internet stocks are going to continue to bounce, then I think that you need bonds to break out. So if you're looking at, if IEF is above 100, how can you not err on the long side of both bonds and growth, right? That's how I look at it. So it's at a key level, no?
Yeah, I mean, you make a great point about the intermarket implications of this base breaking out, right? It's not uncommon for us to overlay this chart or TLT usually with ARC or some sort of a growth index, right? Because the correlation there is very strong. I think as with a lot of charts right now, whether it's tech or bonds, right? This is a base building process. You see the sideways 200-day moving average. These patterns can take time. I think there's a very clear reversal pattern taking shape, but it hasn't resolved higher yet. So we need to see these things break out and sustain their new highs before we get too bullish bonds.
100 on the IEF. You know, if you're above 100 on the IEF, then, you know, have a ball. You can buy as many bonds as you want, as far as I'm concerned. I think that's good for tech. You know, probably indicates that rates are going to remain under pressure, right? That's how I'm looking at that. So we'll have to come and see. Mr. Straza, gold is making new highs against both stocks and bonds. Is this the place to be in 2023?
I mean, you may or may not know this, JC, but when assets are in strong uptrends or bull markets, they tend to outperform their alternatives. What is an alternative or two for gold? We have bonds, we have stocks. Doesn't matter what it is these days, gold is making new highs against it. I would go back to this GLD-TLT overlay chart. The correlation here is really strong. Go to the next one. When gold is outperforming bonds, it tends to be a really good thing for gold on an absolute basis, right? It's why this chart looks so similar. These two charts look so similar. So I think this new breakout here for the GLD-TLT chart really bodes well for a coming breakout in gold on an absolute basis.
Keep in mind that bonds have been in a bull market for my entire life, since the early 80s. And so it's not like these long-term charts on a relative basis are comparing it to a poorly performing asset. You're looking at long-term secular bull markets and bonds, and GLD making new all-time highs relative to those bonds. I think that's impressive for sure. When gold's outperforming bonds, gold's probably doing pretty well, for sure.
It's not uncommon for us to see this, right? We use the relative trend for confirmation, even when we're looking at individual equities, right? We want to see the relative trend confirm what we're seeing on an absolute basis. You could look at it the other way too, where if the relative trend leads the absolute trend, that's great information too. So
gold outperforming commodities here shows you that oil's been under pressure, which is a little bit of a foreshadowing. We'll talk about that shortly.
Microcaps. Microcaps are flirting with new lows. What are the smallest stocks telling us?
I mean, it looks like regional banks. It looks like small caps. I would say, probably small caps probably the best comparison right here. Back to the pre-COVID highs. Financials are retesting those pre-COVID highs as well. There's got to be some element to that. Straza, where I grew up, triple bottoms are not too common if they even exist at all. 1, 2, 3. I don't know. The more times the level is tested, the higher the likelihood that it breaks. Is that what's happening here? Similarly, we were just talking about IEF, which is the Treasury bond ETF. How if we're above 100, you got to lean on the long side. Here's the exact opposite. If IWC, which is the microcaps ETF, is below 100, you got to lean risk off. And if microcaps are selling off, what does that say about the overall market? So like the IWM, testing key levels, IWC doing the exact same thing. That's front and center.
So when I look at this chart, the big piece of information that I'm getting from it is laggards lag, right? That's what they're supposed to do. So at an index level right now, we can look at something like microcaps. They're the weakest group of anything out there, right? The large cap indexes are much stronger these days. Mid caps had their day in the sun earlier this year, late last year. So if you look at microcaps, we have this key level, like you said, just north of 100. If we violate that, that's likely to happen first, right? And tell us that further volatility or further selling pressure is coming for the large cap space. So I think that one's full of information right now.
And by the way, one more thing, just because microcaps are underperforming doesn't mean that that's bad for the market, right? We've seen plenty of times that small cap stocks and microcap stocks have been underperforming the large caps, and stocks are doing well in general. Specifically on an absolute basis, if IWC is breaking 100, then that is definitely bearish. So on a relative basis, don't overthink it, but on an absolute basis for sure. Straza, Uncle Warren just filed his latest Form 4. I know how excited you get when he does that. Is Berkshire still Berkshire still buying Oxy? Are you though?
Listen, I think it's $60 for Oxy, right? On an individual stock basis. 60 is the level for Oxy. They keep coming out, keep buying it at or below this level. The Form 4 from late last night, I think was about 200 million, 3.5 million shares. So still just over 30%. It wasn't really a large purchase. We see just here his last purchase earlier in the month, he bought 5.8 million. So just a little bit over half of that in last night's Form 4. I think the next chart is the most important one for this theme, though. If I want any exposure to energy, no, the crude and XLE. If I'm going to have any exposure to energy, I want these charts to not be breaking, right? So those 2018 highs are just so critically important to the energy trade. Broadly speaking, for me to want exposure to Oxy, I want these charts to be above their 2018 highs.
100%. And it's funny because these circles, for those of you guys who are unaware, these are all the times that Warren Buffett filed a Form 4, meaning he was buying Oxy stock every single time it dipped below 60. It's him buying. So when you talk about institutional support, this is literally Warren Buffett buying every time Occidental Petroleum gets below 60. These are the list of buys. By the way, Straza, at this point, how much does he own? Is he like 32, 33%?
It's just over 30%. This
just over 30%, slightly over.
Yep.
Yeah, so the risk is well defined. 60, you can even go as low as 58 if you want to give it a little more room, but that's the Buffett buying zone. If you're above 58, $60, I think you can buy as much as you want. I think you got 30, 35% of upside, no doubt about it. And again, I think that trade only works if the XLE, which is the energy index, and oil are above those 2018 highs. Otherwise, I think you're going to have a really tough time being long anything in energy, not just Oxy. It's nice that Warren Buffett is buying Occidental Petroleum. Don't get me wrong, but is that the reason why we're buying the stock? I think there's bigger, more macro themes here, and energy doing well is wind at your back, being long any energy stock, whether Warren Buffett's in it or not.
Yep. These are commodity stocks. At the end of the day, they need oil prices to at least stabilize here, right? So the Buffett zone is so cool. You ever been to SeaWorld? You know, they have the splash zone at SeaWorld.
Right. Nice.
This is a different kind of whale.
I see what you did there. I see what you did there.
All right. Oh, my favorite game. So this is a game that we like to play. I'll say a word or phrase. You tell me the first thing that comes to mind. Buy now, pay later.
First thing that comes to mind is hustle. You know, someone's hustling you. This buy now, pay later thing. Someone's getting hustled. You're probably, you know, you're the sucker, right? There's no free lunch. I'd be weary about that. I'd say be able to afford it. Buy now.
So I just heard the news about Apple this morning. They're now launching Apple Pay Later. And, you know, we have Affirm. We have some other buy now, pay later stocks that came public after the pandemic, you know, during the growth stock run 20 and 21. And they're all getting hit today. All I'll say is it's so hard to be a tech stock or to even compete in any space that Apple or Google or Microsoft might want to compete in the future. It's just really tough out there because these guys continue to gobble up all the best industries.
But technically, they can compete in any industry. So, like, you just don't start any companies. You know what I mean?
It's hard, right? But for them, it's nice. They could sit back, watch the buy now, pay later firms come out, figure it all out, go through the growing pain, and then decide, oh yeah, that's a business we want to be in. Let's go do it better. So, you know.
Well, I mean, look at MasterCard and Visa. I mean, look at those stocks. Zoom out. I mean, isn't that a version of buy now, pay later?
Yeah, for sure.
Look at those stocks, right? What's the
Apple
difference?
Gonna take them over one day?
I mean, why? But why are you know? I mean, listen, it's a good model, not for the consumer. It's a good model for the business, right?
I call it buy now, pay never. I mean, if you don't have $50 to buy your pet food on Amazon today, you probably aren't going to have it next week.
All right, 2-minute drill. Baba in China. Alibaba, the largest stock in China, it's splitting its business up. The stock is rallying today on the news. Do we like China here?
Yeah, so just to be clear, it's not a stock split for Alibaba. It's a business split. They're looking to spin off, which to me is crazy. And, you know, all of the whispers today are, you know, whether or not it's politically motivated and what the CCP has to do or doesn't have to do with this move. But this is the biggest company in China. This is like our Amazon coming out and telling you AWS is going to be separate, you know, Amazon's going to be separate, Whole Foods is going to be separate, and doing a big spinoff of all of their businesses. So it's a big deal. And then again, the bid in the stock today is, you know, we've seen this since the beginning of time. This is just a classic way to generate shareholder values, to spin off all the parts of the larger company.
Stock's up 14% on the day as we're recording this. You know, to me, getting back to what we're talking about on bonds, you know, these bases, it looks, you know, they look like TLT, you know, looks very similar. It looks like IEF, these bases. And, you know, are these bearish to bullish reversals? We still haven't gotten those breakouts. You know, when we look at IEF, I could punch that up right now just so you can get an idea of exactly what we were talking about. Here's IEF, right? Here's your support last year. Here's your base. And now we're up against resistance. What did we see? What are we seeing in Chinese technology? Saying the same thing, right? Lower lows, back up to this resistance. It's the same. To me, it's the same trade. So if interest rates fall, I think you can bet on higher Chinese stocks, higher Chinese internet, you know, Baba breakup or otherwise. I think it's an extension of the bond trade. I still do.
I'm with you. Yeah, no, it's a great point. Are we hitting on a theme here? I mean, we talked about how we overlay these growth indexes with the bond ETFs. This could be one of them, right? Chinese technology. I would say the same thing that I said about bonds. I like these from a perspective of they stopped falling, right? And we're seeing all the same patterns throughout China. I brought 3 of the largest components in the ETF along just to make the point, but these are still charts that are in the base building process and probably need more time. I would love to buy these when they resolve higher from these beautiful bases, but they're not ready yet.
All right, Straz, a hot take. You go first.
Hot take. Listen, despite all the positive developments that, you know, maybe happening over the past few weeks and growth stocks doing well, Bitcoin making new highs, The price action in the banks is very concerning, right? And luckily for us as technicians, we can manage our risk responsibly, and we can use polarity zones and look at these prior cycle highs. Couldn't be a better level, right? There's your line in the sand. Everything is all okay with financials and therefore the broader market if we're above these prior cycle highs. We're below there, who knows, right? But for now, we're above there. This level, this chart, nothing's more important to me right now.
All right, so Disney's getting rid of their metaverse, and it looks like all this stuff is falling apart. What I think people fail to realize is that we've already been living in the metaverse. A lot of us are friends because we met on Twitter or YouTube or Yahoo Finance message boards even before that. We've been living in the metaverse for a long time, and fortunately, over the years, we've gotten to meet IRL, right, in real life, but we all are speaking on the internet. And, you know, we could probably even include maybe Zoom now as part of the metaverse if you want, or some sort of, video conferencing, even though it's something that's existed for a while. It's hard to kind of ignore that, but even forget all that. Just, Twitter and YouTube and social media and the blogosphere. And, in the old days, we used to hang out in the comments section in some of these blogs. I mean, it's really evolved over the years, but it's all the metaverse. We've already been living it for years. People just got to learn to deal with it. No?
You know what? In hindsight, it's also clear to me now. You know what the peak for the metaverse was? It's when we were talking about having meetings and hosting conferences in Decentraland. That was clearly the peak.
That's going to happen. I mean, we do that now. Chart Summit was essentially that for all intents and purposes, and we will do it again. Listen, ladies and gentlemen, thank you for watching. Make sure to give us a like and hit the subscribe button so that you never miss an update, and follow me at All-Star Charts, and be sure to follow Steve at S Straza. Leave a comment below. Let us know what you think, and we will see you next week.